What if instead of paying taxes every year, you could take that money and buy investment real estate? I'm gonna let you in on a little secret. It's actually possible. Well, that's exactly what we're gonna talk about in today's video. I sit down with Kenji and Leti from Semi-Retired MD, and they explain how they've been able to do this over the last 7 years. If you get any value out of this video, please remember to like and subscribe. And without further ado, let's get into it. All right, so I'm here with Kenji and Leti. They both started out as physicians working full-time in the medical industry, but since then, they've been able to build up a successful portfolio of real estate investments, both in the United States and internationally. And their organization, Semi-Retired MD, helps doctors and high-income earners do the same thing. They host the Doctors Building Wealth podcast, and they recently published a book, which we'll talk a little bit more about later, called Life on Your Terms. But Kenji, Leti, thanks so much for joining. Welcome to the channel.
Thank you so much, Cody, for having us, and we're so excited to be here.
So I'm a multifamily real estate broker here in Southern California. I have a lot of clients who are medical professionals who are pretty shocked to learn just how beneficial real estate can be, not only from a wealth building perspective, but also from a tax perspective, which I know you guys cover this a lot in your organization. So one of the reasons I wanted to have you on is to kind of break down some of the tax benefits that are available for people right now. So can you tell us what's the big benefit that you're seeing right now from a tax perspective?
So when we started investing in real estate, Kenji and I started together in 2015. One of the main drivers for us was definitely taxes. We realized that there was something called real estate professional status. That first year that we started investing, it was very lucky that we came across it. And what it allowed us to do is we actually had Kenji cut back to half time as a doc that first year, and then he became a moonlighter. And that's a huge step to take, especially if you're a high income earner. And I think a lot of people have fear about that because they worry about the loss in income. But one of the things we committed to was making sure that we bought enough property so that he could get real estate professional, and so that we could create so many losses that it was going to be able to mostly, if not fully, make up for the loss in income. So what we did that first year is we ended up with 12 doors, and Kenji can talk a little bit about the logistics of real estate professional status. But what we did was we were able to depreciate all of those doors. We did a lot of rehabbing. Back then, there was no bonus, 100% bonus depreciation. We didn't know about accelerated depreciation. So what we did was we just did a lot of rehabbing, took straight line depreciation, and actually sheltered our incomes that year. And so it ended up we didn't pay income taxes for 7 years, which really, really helped with the creation of our wealth.
Yeah, for high income earners, there are very, very few tax benefits. There's hardly anything that you can write off. And so anybody listening to this who's a high income earner probably already knows this. And so this is one of the few ways that you can significantly reduce your taxes. And like Leti said, for us, we were able to eliminate our income taxes. And we used to live in Washington State, which didn't have any state income tax. So we were able to eliminate all of our income taxes, both federal, and we paid zero state as well.
And I know taxes are painful for people to pay. October 18th, I believe, was taxes were due. So I'm sure people watching this are sort of reeling from that if they didn't know about this ahead of time. And I want to talk more about those tax benefits that you just mentioned. But before we get into it, I'd like to take a step back and kind of hear about your journey. So how did you go from, medical professionals, you weren't investing in real estate, to where you are today?
Yeah, so Kenji and I are both physicians. I'm family medicine trained, and he is internal medicine trained, and we were both hospitalists. So we were working in the hospital taking care of ill people. And back in 2014, we had just gotten married, and we were thinking about going out, buying a primary residence, starting a family, like all those things that newlyweds think about. And we happened to just get so lucky and read Rich Dad, Poor Dad. Kenji had already read it previously, but I read it and just got very excited about it. We read it together out loud, and that allowed us to create this plan that we were going to invest in real estate, because we didn't want to be stuck in week on, week off for the rest of our lives. And we realized we needed another source of cash flow that came in every single month that was going to allow us the freedom to be able to work in medicine on our terms. That's why our book is called Life on Your Terms. And so what we did was we decided that very first year, like, hey, we're going to focus on real estate. We decided we wanted to replace both our clinical incomes in 7 years. So we had a very clear goal of what we were going for. And so every dollar we had went into real estate. We even decided not to get a primary residence. So we didn't buy a home together that year. And in fact, we didn't buy a home until last year was our first year. And only because we were required to in Puerto Rico did we buy a home. We've always rented because we wanted every single dollar to go into investment properties.
Yeah, if you're trading time for money, you're not going to build wealth unless you basically kill yourself and work to death, right? So ultimately what we realized was there was a cap on what we could do. I mean, physically, I mean, there's only a certain number of hours in the day, right? And we weren't willing to sacrifice our personal lives and our future personal lives. At that time, we didn't have kids, but we knew, we were going to have kids. Now we have 3 kids together. And so we knew that just looking forward, like the only way we were going to achieve freedom, that time freedom that we desired, as well as making significant amount of money at the same time, right, was to decouple that trading that time for money. And so that's why, we decided to invest in real estate, which there is work up front that needs to be done. And you do need to put in the hours for real estate professional status, as well as the short-term rental tax loophole, which we haven't talked about yet. But if you want to do those things, you do have to put some hours in, but it's not at the same level. You're able to make a significantly more money for the amount of time that you put into it. So there is this decoupling of time and money.
Yeah, and so we started in 2015 together. I mentioned that we got to 12 units that first year. Now we have over 150 doors in multiple states. Like Kenji and I mentioned, we didn't pay taxes, federal income taxes for 7 years using tax loopholes. And just, it's given us this life we love. We live in Puerto Rico half time. We travel the rest of the time. We got 3 little kids, and we're able to really have that time and space freedom. So it's really because of real estate.
Kudos to you guys. I know, when you're working your way through medical school and then residency, it's a lot of years that you're investing and sacrificing. And, once you complete that and you start earning that high income as a doctor, it can be really easy to get trapped into that life where you're, buying liabilities like a house with a high payment, really nice cars, and then you're sort of trapped by your job. So congrats to you guys for recognizing what you wanted up front, which really sounds like time freedom, and navigating towards that. And now you're helping other people do the same thing. So taxes. So I want to talk about the taxes. So you mentioned real estate professional status and bonus depreciation. Can you kind of break down what that is for the listeners?
Yeah, so real estate professional status is a tax status. It's written into the IRS code, and it's not, you don't need a license. Anybody can qualify for it. And really, it just requires you to spend time in real estate. And so the time requirements are, first, you need to do more hours in real estate than any other job. So if you're a doctor, if you're an engineer, if you're a PhD, whatever it is, if you're a lawyer, you have to do more hours in real estate than your primary job. So let's say if you're a lawyer, for example. And so that's the first requirement. The second one is a minimum of 750 hours. So, it ends up being about 15 to 20 hours a week if you average it out over the course of a year. And then the last one is you need to materially participate in the property, which means that, you need to own your own rental properties, and you need to be, to a degree, you need to be hands-on, you need to be involved in the operations of it. And so if you meet those criteria, again, you spend the hours on real estate, then as long as you have properties and you're able to create losses on those properties, and we're talking about paper losses, not real losses, then you're able to use those losses against your W-2 or 1099 income, your earned income, and you can shelter it. And so, for example, if you're making $250,000 per year W-2 and you create $250,000 in real estate losses, then you're able to offset the income completely and pay zero in income taxes.
Yeah, so just to translate that into, what we did, we had Kenji cut back down to half time and then a moonlighter because we needed him to spend more time in real estate than anything else. And then we also needed him to do over 750 hours a year in real estate. In fact, we needed him to do more like 1,000 that first year because he needed to do more time in real estate than as a doctor. And then we needed to make sure we bought enough properties that a majority of that time was spent on our own properties. And so that's why we went out and bought so many properties. And that's also part of why we did so many rehabs. We had Kenji spent a lot of time overseeing contractors and finding contractors and overseeing that work, which really helped the hours add up. And even did things like he did all of our asset protection structure, all kinds of stuff to make sure that he had enough hours that year.
Interesting. And so semi-retired MD, your organization, you help other medical professionals do the same thing. Is that sort of the typical story? You see people who are in your organization where it's two doctors and then one cuts back, or are there other ways that people can do this?
Yeah, most of the time I will say it's not a dual physician couple. It's oftentimes couples where one person is a doctor, and sometimes the doctor cuts back, but a lot of the times it's a spouse that's the stay-at-home spouse decides to get real estate professional because they don't need to cut back, right? Real estate already can be greater than 50% of their time, and they really only need to get above that 750-hour threshold. Sometimes it's also a spouse who doesn't like their job very much or just wants to fully quit. And sometimes we have dual physician couples where one partner will cut back, but I would say majority of time that's not the case. And I should also mention that real estate professional is for long-term rentals. So those have an average length of stay of 8 days or more. So we have a lot of people in our community who are doing the traditional long-term rental, but a lot of people who are doing midterm rentals too, which are furnished, and they're renting them out for 30, 60, 90 days. And so that still counts. They need to get that real estate professional because those still count as a long-term rental in order to be able to get this status and put in the hours.
Yeah, and then I wanted to mention the short-term rental tax loophole, which is that if you materially participate, which means that you're hands-on with your property, you're involved in the operations of the short-term rental, then you can also shelter income, and you don't actually have to cut back like I did that first year. You're able to continue to work full time. So this is good for somebody who, maybe it's a dual career household. So again, it's not only doctors; it can be other professions as well. So let's say they're dual career, both working full time. Short-term rentals could be a great way to shelter their income, and also for somebody who doesn't have a significant other, they're single, or divorced or widowed or whatever it is. They're also able to go out, and even though they're working full time, they're able to shelter their income using a short-term rental. So there's a number of different strategies, and we, 1 year when we bought a short-term rental, I did real estate professional status as well as the short-term rental tax loophole and created losses on both the long-term rentals and the short-term rentals, and then used that to shelter our combined income.
And short-term rentals have an average length of stay of 7 days or less.
Mm-hmm.
Someone who's interested in doing this, they would first need to figure out how to qualify for either rep status or the short-term rental loophole, or not the short-term rental investor status. And then once they buy a property, you mentioned bonus depreciation and cost segregation. Can you break down what that might look like for someone?
Yeah, sure. So cost segregation is a study that you do on the property to break down the property into different components and break them out into different buckets of lives. So every component in the property has a certain useful life. And so something like an appliance is not going to last 100 years, right? It's going to last, let's say, 5 to 7 years. And so what this cost segregation study is an engineer goes out to your house or property and looks at all the different components, breaks them down into a huge spreadsheet, and basically assigns a useful life for every single component. And basically anything that has a useful life of 20 years or less can be bonus depreciated, which means that you're able to take something that was, let's say, has a useful life of 5 years, and then claim that entire depreciation for that 5 years of life all in 1 year. And so you're able to front load a lot of that depreciation in the first year. So let's say that you have $1 million worth of, let's say the value of a building is $1 million. And then let's say that 25% of that, or $250,000 dollars worth of that, it has a useful life of 20 years or less. And you're able to basically take that $250,000 and instead of spreading it out over years, you're able to claim that $250,000 in the first year. That's what bonus depreciation is. And so again, you're able to front load a lot of that depreciation and therefore create these large losses. And that's what makes it significant because again, for high income earners, they're making a large salary. So they need these big losses in order to shelter their income. If they don't have the big loss, then it's not going to have as much of an impact. And that's why bonus depreciation is very, very helpful. Now, bonus depreciation is being phased out over time. And so in that situation, what you can do, and what we actually did the first several years when we invested before bonus depreciation was available, was that we were renovating a lot. And so we would buy properties that needed to be fixed up, and we were renovating them. And again, you can use a lot of those renovations as losses that you can use to offset your income.
And you can even bonus depreciate your renovations too. So what we often do is we'll buy a property, we'll take bonus depreciation, and in 2023, that's 80% bonus depreciation. In 2024, it's gonna be 60% bonus depreciation. So we take that initial bonus depreciation chunk that first year, then we go and we renovate, and now we can write off all of those new things that we put into the property. Some of them will be expenses written right off the bat the first year, but then some of them will be things that are 15-year property. So we do another bonus depreciation on that stuff. So you actually can get, like Kenji said, you can get a lot of those losses offset to the first year, even with the rehabs, and that adds up very, very quickly. And if it's active losses, meaning that it actually has the ability to shelter W-2 income from taxes, it really makes a huge difference. And then the next year you get that IRS check back, and now that's your down payment for the next property or your rehab money for the next property. And so your property, your portfolio grows very, very fast compared to how it would grow if you were just saving up for the next down payment.
Now, I wanted to point out that we are not CPAs. I wanted to put that disclaimer in there because that's really important. You need to seek professional assistance on taxes. But you know, again, we've done this for so many years. We've claimed these statuses ourselves, and we've also taught this for years. So, and we have a large network of CPA partners that we work with. So this is where our knowledge is based on. But if you're talking about your specific taxes, you know, you need to take into account, right, the state that you're living in, where you're investing, right, because you have to think about that as well, because where you're investing in could impact your taxes. So again, you have to take into account your personal circumstances in order to figure out what's best for you.
And so you guys learned about this tax strategy, you invested in that first building, got this big tax write-off, and then continued to do this. So really you were supercharging your real estate investment portfolio, eliminating all of your federal income tax and really accelerating how fast you could, you know, build up that passive income.
Exactly.
Yeah, exactly. That's right. Yeah, it's a huge, has a compounding effect because when you're not paying your tax, having to set aside money for taxes, which is your single biggest expense, if you're able to take that money and reinvest it, which is what we did, right? We continued to work. Leti eventually cut back to half time, but initially I cut back to half time, and then I was moonlighting, and then Leti was continuing to work full time. So we still had an income, but any of the tax savings we just put right back into our real estate portfolio. So it really just turbocharged our growth, and we were able to grow our portfolio very quickly in a short amount of time.
So I think we covered a lot of good stuff. If people want to learn more about your organization, where can they go to get more information?
Yeah, so our company is called Semi-Retired MD, and that's where we train people how to invest in real estate and how to save on taxes, a lot of what we've covered today. But I also wanted to mention our book, which is called Life on Your Terms, because it's a really great way to get started. It really it's written as a fable. It's a story of two doctors as a couple who go and invest in real estate, and then another couple that goes kind of the traditional route, you know, work harder, invest in their 401k. And it talks about the trials and tribulations and the journey of the two doctors investing in real estate, because a lot of what we've realized over the years is how important mindset is to being able to successfully grow a real estate portfolio. So this allowed us to not only put the strategy into a book, but also talk a lot about the mindset. So we threw in a lot of drama and a lot of challenges for our main characters to face so that they could show a lot of those mindset skills that if you have, are going to help you be so much more successful in investing in real estate. And for readers of our book, we actually have a free offer for Ignite Your Journey, which is one of our introductory courses. It's normally $200, but we have a free offer. So we'll give you that link, Cody. You can throw it in the YouTube notes or whatever, and be able to give it to your people who want to read our book.
Amazing. Well, Kenji Leti, so thank you so much for joining. Be sure to check out Semi-Retired MD, check out the book, Life on Your Terms, check out the podcast and the courses. And yeah, appreciate you guys' time. Thank you again. Thanks so much for watching. For the most up-to-date info on real estate investing, be sure to like and subscribe. And remember, invest well, trust Cody Charnell.